Can I survive a full year of retirement without triggering an IRS audit? That question honestly kept me up at night when I first retired. And the more I talked to other retirees, the more I realised I was not alone. Most of us go into retirement thinking, okay, I worked hard, I paid my taxes, I am done with the complicated stuff. But here is what nobody tells you. Some of the most ordinary things you do at your bank, things that feel completely normal, completely innocent, can quietly put your name on a list you really do not want to be on. Today on Retires with Linda, we are going to talk about exactly that.
I am going to walk you through 7 common bank moves that retirees make every single day, moves that the IRS actually pays attention to. And before you think, oh, that will never happen to me, I want you to stick with me because number 4 on this list surprises almost everyone who hears it. And number 6 is something retirees are doing more than ever right now without even realizing it is a red flag. If you are new here, welcome. This channel is all about helping retirees protect what they have worked for, avoid costly mistakes, and actually enjoy this chapter of life without financial stress. If that sounds like something you need, go ahead and hit that subscribe button right now. We put out new videos every week, and you do not want to miss what is coming up. Okay, let us get into it.
So here's the thing about the IRS. Most people picture an audit as something that happens to millionaires or to people doing something obviously shady. But the IRS does not only go after the wealthy or the dishonest. They use automated systems and algorithms that scan financial activity for patterns. And certain patterns get flagged automatically. No human even has to look at it first. The system just sees the activity, and a process begins. As a retiree, your financial life looks different than it did during your working years. Your income sources have changed. Your bank activity has changed. And some of that new normal activity happens to match patterns the IRS watches very closely. This is not about doing anything wrong. This is about knowing the rules of the road so you do not accidentally end up in a situation that costs you time, money, and a whole lot of stress. Because trust me, nobody wants to be the person sitting across from an IRS agent trying to explain a bank transaction from 3 years ago. Let us make sure that never happens to you. The first move that can trigger IRS scrutiny is making large cash deposits or withdrawals. And when I say large, I'm not just talking about extraordinary amounts. Under a federal law called the Bank Secrecy Act, banks are legally required to report any cash transaction of $10,000 or more to the IRS. That report is called a currency transaction report, and it goes directly to the federal government. This happens automatically. You do not get a warning. You do not get a chance to explain. The bank just files the report.
Now here is where it gets a little tricky for retirees. Some people learn about that $10,000 threshold and think, okay, I will just keep my transactions under that amount. Maybe they make a series of withdrawals, 9,000 here, 8,000 there, to avoid hitting that number. That behavior has a name. It is called structuring, and it is actually a federal crime even if the money itself is completely legitimate. The IRS and federal investigators specifically look for patterns of just under 10,000 transactions, especially when they happen repeatedly or close together in time. So if you are doing this, even innocently, stop right now and talk to a financial advisor or a CPA about the right way to handle larger cash needs. For retirees, large cash moves often come up when helping a family member, making a major purchase, or moving funds between accounts. All of those situations have perfectly legal ways to handle them that do not draw attention. The key is documentation and understanding what your bank is required to report. The second move to watch out for is making frequent large transfers to family members. This is such a common one, especially for retirees who want to help their adult children or their grandchildren. You sell an investment, you get a nice chunk of money, you want to share it with the people you love. That is a beautiful instinct. But the IRS has rules about gifts, and if you are not following them, you could end up creating a tax problem, either for yourself or for the person receiving the money. The annual gift tax exclusion for 2024 allows you to give up to $18,000 per person per year without any reporting requirement. If you go above that threshold with any single person, you are technically required to file a gift tax return, which is IRS Form 709. Now, most people do not owe any actual gift tax because of the lifetime exemption, but the failure to file that return when required is something that can come up during an audit. and if you are making large transfers regularly without any documentation. It starts to look less like a gift and more like unreported income, which is a very different conversation with the IRS. Keeping clear records, having an understanding of the annual exclusion limits, and talking to your tax preparer before making big transfers to family can save you a lot of headaches down the road. The third move is withdrawing money from retirement accounts in irregular or large amounts. When you hit age 73, you are required to take what is called a required minimum distribution from your traditional IRA or 401k every year. The IRS requires these distributions because they want to collect the taxes on that money that you deferred over your working years. If you do not take your RMD, the penalty is steep. Historically, it has been 50% of the amount you should have withdrawn, though recent legislation reduced that somewhat. But beyond just the RMD itself, irregular or unusually large withdrawals from retirement accounts also get attention. Here is why. When your financial institution reports distributions from your IRA to the IRS, and then your tax return does not match what was reported, that mismatch triggers a flag. Same thing happens if you withdraw a large lump sum compared to your history. Maybe you needed money for a major medical expense or a home repair. Those situations happen, but you want to make sure the income is reported correctly on your return and, where applicable, that you are claiming any exclusions you are entitled to, like the medical expense deduction. Always make sure your tax return lines up with what your broker or custodian reports to the IRS. Any gap is a potential problem. The fourth move, and this is the one that surprises almost everyone, is depositing Social Security checks or pension payments into multiple accounts or changing your direct deposit frequently. This sounds so routine. You open a new account maybe to take advantage of a better interest rate. You split your direct deposit. You move things around. What is the big deal? Here is what most retirees do not realize. The Social Security Administration and pension administrators report your benefits directly to the IRS. When those payments start showing up in unexpected accounts or there are inconsistencies in how they are being deposited, it can create discrepancies that trigger a review. On top of that, if you are receiving benefits while also having other income sources that push you over certain thresholds, a portion of your Social Security becomes taxable. 85% of your benefits can be subject to federal income tax if your combined income exceeds $34,000 for single filers or $44,000 for married couples filing jointly. A lot of retirees genuinely do not know this and are surprised when they owe taxes on their Social Security. And if the numbers on your return look unusual compared to what has been reported, the IRS is going to want a closer look. The fifth move is using cash for large everyday expenses. We live in an increasingly digital financial world, and large amounts of cash being used for purchases or services raises eyebrows, not just with the IRS, but with financial institutions in general. If you are paying a contractor, a caregiver, or anyone providing services in large amounts of cash without proper documentation, there are multiple risks. First, the person receiving the cash may not be reporting it as income. Second, if you later try to claim those payments as a deductible expense, you need proof, and cash is notoriously hard to document. Third, large cash transactions contribute to the overall pattern of your financial behavior, and patterns matter. This is especially relevant for retirees who use in-home care services, pay for lawn maintenance, or hire help around the house. These are legitimate expenses and often deductible under certain circumstances. But without a paper trail, you are in a much weaker position if anyone ever asks you to justify those transactions. Using checks, bank transfers, or even Venmo-style apps that generate records is a much safer approach. And if someone insists on cash only, that itself might be a sign you should find a different service provider. The sixth move is one that has become extremely common in the last few years, and that is using peer-to-peer payment apps like Venmo, PayPal, Cash App, or Zelle for receiving money. There was a rule change that took effect related to Form 1099-K, which these platforms are now required to send to users who receive over a certain amount of payments through their services. The threshold and the implementation have been debated and adjusted by the IRS over the past couple of years, but the direction is clear. These platforms are being required to report activity to the IRS more broadly than before. For retirees, this matters because a lot of family financial sharing happens through these apps. Splitting a bill with a sibling, receiving money from your kids for a birthday, getting reimbursed for a shared vacation expense, all of that can technically show up in the reporting if you are not careful. The IRS may receive a 1099-K suggesting you received income when in reality it was just a family transfer. This does not mean you will automatically owe taxes, but it does mean you need to be able to explain the transactions, and it means the numbers on your tax return need to reconcile properly with what was reported. Talk to your CPA about how you use these apps and whether any adjustments need to be made to how you handle money through them.
Now we are getting to the seventh move, and I want you to really pay attention here because this one carries the most potential for serious consequences. The seventh move is having foreign bank accounts or financial interests abroad and not disclosing them properly. You might be thinking, well, I don't have any foreign bank accounts. And maybe you don't. But here is where it gets complicated. Do you have a brokerage account that holds foreign stocks or international funds? Do you receive any income from foreign sources? Maybe rental income from a property in another country, or payments from a foreign pension or inheritance? Have you ever co-signed anything with a family member who has accounts overseas? All of these situations can create disclosure requirements that many retirees are completely unaware of. The rules around foreign bank account reports, commonly called FBARs, and the Foreign Account Tax Compliance Act, known as FATCA, are serious. The penalties for failing to file the required disclosures can be enormous. We are talking tens of thousands of dollars in fines per violation, and in extreme cases, criminal charges. The IRS has made pursuing offshore accounts a major enforcement priority, and the net is wider than most people think. If any of this applies to your situation, you need to talk to a tax professional who specializes in international tax as soon as possible. There are programs that allow people who have made mistakes in this area to come into compliance without facing the worst penalties. But those options are better pursued proactively than after the IRS comes knocking. Now, I want to take a step back for just a moment because I realize this is a lot of information, and some of it can feel overwhelming or even a little scary. But here is the perspective I want you to carry with you. None of these 7 things are traps set up to get you. They are areas where the rules are often misunderstood, or where ordinary behavior in retirement happens to overlap with patterns the IRS watches. The solution is not to live in fear. The solution is to be informed, and you are already doing that just by watching this video. The retirees who get into the most trouble with the IRS are almost never the ones doing something intentionally wrong. They are the ones who were not paying attention, who never thought to ask a question, who assumed everything would just work itself out. That is what I want to help you avoid. Being proactive, keeping good records, working with a good CPA or financial advisor, and staying aware of how your financial activity looks to the outside. Those are the things that protect you. Let me quickly recap the 7 moves we talked about today. Number 1 is making large cash deposits or withdrawals, especially in patterns that look like you are trying to stay under the $10,000 reporting threshold. Number 2 is making frequent large transfers to family members without understanding the gift tax rules and filing requirements. Number 3 is taking irregular or unusually large distributions from your retirement accounts without making sure your tax return matches what your financial institution reports. Number 4 is changing your direct deposit of Social Security or pension payments frequently, or splitting it across accounts in ways that create discrepancies. Number 5 is using cash for large everyday expenses without keeping any documentation, especially when those expenses might be deductible. Number 6 is using peer-to-peer payment apps in ways that could generate 1099-K reports that do not match your actual tax situation. And number 7 is having any kind of foreign financial interest or account without understanding and fulfilling your disclosure obligations. If even one of those 7 things made you think, oh, I need to look at my situation more carefully, then this video did exactly what it was supposed to do. And here is my strong encouragement to you. Do not wait. If you have questions about any of these areas, talk to a qualified tax professional. Not a tax preparer who just plugs in numbers, but someone who understands retirement finances and can review your whole picture. The cost of a consultation is almost nothing compared to the cost of getting caught in an IRS situation you could have avoided. And if you are sitting there thinking, okay, but how do I even find the right advisor? Or what are the other financial mistakes retirees make that nobody talks about? I have got you covered. We did a video not long ago on estate planning mistakes that retirees make all the time, and some of those mistakes tie directly into what we talked about today. I am going to link that video right here so you can watch it next. It is one of the most important videos on this channel, and I think it will really complete the picture for you. Here is what I want you to do right now. First, if you found this video helpful, hit that like button. It genuinely helps more retirees find content like this, and that matters to me a lot. Second, leave a comment below. I want to know, have you ever had a situation where your bank activity got flagged or questioned? Or is there a topic related to retirement finances that you have been wanting us to cover? Every single comment gets read, and your questions often become future videos. Third, share this video with someone you know who is in or approaching retirement. These are the kinds of things that people genuinely need to know, and sharing it takes about 10 seconds and could save someone a serious headache. And finally, if you have not subscribed yet, please do. Hit that bell notification too so you never miss a new video. We are here every week with information that helps you protect your retirement and enjoy this chapter of life the way you deserve to. This is Linda, and I will see you in the next one.